So good afternoon and welcome to you all to today's online seminar debate organized jointly by Bruegel and the Florence School of Banking and Finance. The topic of today's webinar is Rationale and the Limitation of SURE, where SURE stays for support to mitigate unemployment risks in emergency. My name is Elena Carletti. I am a professor of finance at Bocconi University. I will be chairing the debate today. So also on behalf of Bruegel, I would like to welcome our speakers for the debate of today. In alphabetical order is Professor Roel Beetsma, Professor of Pension Economics at the University of Amsterdam, Grégory Claeys, who is a Senior Fellow at Bruegel, and also a former EUI PhD student. So welcome you back, Grégory, to the EUI for once. And finally, Gilles Mourre, who is the head of the unit of fiscal policy and surveillance at the European Commission in DG ECFIN. So thank you to all for joining us today. I really much looking forward to the debate on this new instrument. So what is the debate about? We will focus on SURE, as we said, but we will start with Gilles, who will present us the institutional details of the instrument, the steps that are still needed for the final approval, but we understand is very much advanced. And then we will discuss with Grégory and Roel the potential effectiveness of this new instrument, and they will basically act as discussant. We are very happy to have Gilles today because we understand he is the lead negotiator of this instrument, so he knows everything. He will not be able probably to share with us all he knows, but we really much looking forward to what he will present. So this time we're using, as you may have noticed, for those of you that are used to follow our seminars, we are using Zoom. So that means that for the Q&A part, the procedure is slightly different. You can find the Q&A chat box at the bottom of your screen, and you are welcome to start typing in the question at any time you like. So the chat box is basically open from the beginning. And then, so you can start writing, and please try to make the question short. And also, in case you want to indicate a specific person you want to ask the question to. But most importantly, please keep it short. With no further ado, I will then leave the microphone to Gilles for his presentation. I understand that he has slides, and please, the floor is yours. And you have 50 minutes, while the two discussants will have 6 minutes each. Please.
Thank you very much. So I will load my presentation, but just before, let me thank the organizer for basically inviting me for this nice seminar. So let me present the outline, so the main purpose, scope, and how the scheme works, and making the system financially sound. So the main purpose has been set in the draft regulation, which has been published the 2nd of April, and we couldn't find a better date for this seminar because today, this morning, the Council reached an agreement on the legislative proposal. So now this is becoming a legal reality. And the purpose of this proposal is to establish an EU instrument for temporary support to mitigate unemployment risk in an emergency. It's actually targeted to support short-time work schemes for employees and similar measures, in particular for self-employed. It's an emergency operationalization of European unemployment reinsurance schemes to help European citizens in the specific context of the COVID-19 crisis. And unlike the initial proposal by the Commission, it will be limited in time via a sunset clause. The scheme will stop in the very end of December 2022, in more than 2 years from now, but it could be extendable by batch of 6 months. This is represent a direct follow-up of the Commission communication of the 13th March. So let me roll out for you the whole timeline. I mean, the Commission announced something the 13th March, delivered the 2nd April, which was extremely quick. given our internal procedure. And then now the written procedure is pending in the council and will be concluded the 19th of May. So the timeline has been extremely compressed, measuring up to actually the emergency created by the COVID-19 and also its social economic repercussion. But you have to conceive it as part of the Bruegel package of measure, since the EU needs to use all possible means to address the COVID-19. So the first element of the package was more directed toward actually the direct impact of the shutdown and of course helping the healthcare system, which were under strain. The second batch was actually on the providing liquidity support to firms, especially SMEs, and the last batch is helping worker. And you should see sure in the context of this last batch. So it doesn't have a universal coverage, it's targeted because it's one part of the EU policy response. So what is the scope? I mean, the scope is short-term work scheme. Why? I mean, when there are no orders and company runs out of work because of a temporary external shock like the COVID-19, they risk laying off their workers. So thanks to this liquidity support, national system of short-term work schemes and similar schemes can continue to operate, allowing actually more people to keep their job and continue to support their family and safeguard their incomes during the shutdown and during more generally the COVID-19 crisis. It will also help firms to bounce back from the crisis more easily and more quickly since they have retained their workers and their skills. Before the crisis, a majority of member states have some form of short-time work scheme in place. I mean, some of them have dormant schemes. The amount was not large for most of the country. I mean, only 3 countries has a more developed in terms of financial amount short-time work schemes. But following the crisis, most member states have set up, extend or operate already substantial schemes. And all these schemes are compatible with SURE, which is to be viewed as a second line of defense. I mean, it's the first line of defense being provided by the government by putting in place or operating actually a short-time work scheme and equivalent. So it's actually targeting the SURE is targeting an efficient schemes for this crisis. And this has been, there's been some academic literature and support coming from Bocconi and Lande, Van den Broek and Al, Roel is one of the co-authors of this very interesting column. And actually, this line of literature is stressing that the use of a short-time work scheme is particularly adequate for this type of crisis when you have mandating actually shut down and you risk to have a liquidity crunch. Just to recall, I mean, short-time work schemes correspond to measures allowing firms experiencing economic difficulties to temporarily reduce the hours worked by their employees in exchange they receive public support for the hours not work. I must say that we have been quite open in the regulation because we include similar measure because we wanted to have a purpose-based definition. So, and include the self-employed. So basically all schemes which will allow a reduction of labor costs for firms in exchange of protecting jobs with income support for employees will qualify. This is very important to avoid taxonomical dispute about what is exactly in the remit of short-time work schemes. This was an addition from the Council. It includes also some health-related measures. This was requested by some member states, in particular at the workplace in response to the crisis. And we think that actually it's a fine addition because the resumption of business and the lifting of the containment measure will need actually measure to reduce the occupational hazard and basically improve the work conditions. So it could be a measure related to testing, you know, frequent cleaning, provision of masks, provision of protecting gears. But this could be also an important element to allow, let's say, a safe exit. But the trigger is related to short-term work schemes. The trigger remain that where the COVID-19 outbreak had led to a sudden and severe increase, and concretely increase recorded from the 1st January 2020, when actually Europe started being hard hit by the pandemic, which was already a global one. And so any increase in the any spending increase related to actual or plan measure due to rising from the short-term work scheme and equivalent will be eligible. And of course, the trigger is common sense. And in most countries, actually, we have seen an explosion of basically of the expenditure related to this kind of schemes. So how does it work? Sure will take the form of a lending schemes up to 100 billion euro, underpinned by a system of guarantee from member states of 25 billion euro. With this instrument, the EU could borrow on the market by issuing bonds with low interest rates, benefiting from the credibility of its AAA signatures, and then it will lend the proceeds to the member state concerned. So this is a back-to-back loan, a technique used frequently by the Commission, especially in the past financial crisis, in particular in the context of the EFSM. There is no conditionality on the national schemes, except for the need to provide evidence-based element supporting that there has been increase in current or expecting spendings on those schemes. But of course, the volume of the bond issuance would be constrained by the lack of available funding under the EU budget at the end of the current MFF. Therefore, it was imperative to expand the volume of the loan, providing that sure to get the necessary firepower on the ground. And this could be done by creating a guarantee structure, so the 25 billion, which would allow the EU to lend up to 100 billion. For that, member states must, on the voluntary basis, and voluntary basis is important because there is no legal obligation for member states to do so. Member states must provide a guarantee, which have the usual characteristic of being actually unconditional, irrevocable, and callable guarantee. And this guarantee will be provided to the new union on the basis of bilateral agreement concluded between the Commission and each contributing member states, each and all contributing member states, so all 27 member states. This system basically doesn't require upfront cash contribution, so paid in capital. It's just a guarantee, so a contingent liability. Of course, the system, so you have to see the guarantee as let's say, prudential system to basically allow the EU to get a credible financing device and keep actually its AAA rating. It's why over safeguards are built into the system. There is the maximum concentration limits. So basically 60% is the maximum amount which can be used by the free country receiving the highest amount of a loan. But you have also a constraint on the annual exposure. As you know, the EU budget is basically open and closed annually. And here it was important to make sure that actually the maximum amount of money falling due in a particular year does not exceed 10% of the total of 100 billion. And there will be a possibility to roll over debt in case of a stress as a possible alternative for calling the guarantee. An important element, I mean, the financial assistance will become only available not only after the ratification or the adoption of the regulation, but also after all member states have contributed to the SURE, with the contribution totaling 20% of their amount of loan and the maximum amount of loan, and with individual contribution corresponding to the GNI key. And this is very important. It will be a maximum contribution. So member states, so it's not, let's say, joint guarantee here. The guarantee are several, and they are capped to actually the 25 billion times the GNI key of the country. But let me stress something which is often overlooked. I mean, one of the legal bases for the guarantee for the financial assistance was 1222, but so this was a legal basis used in the context of the EFSM. But Article 122.1 was used to underpin the system of guarantee, of voluntary guarantee. And Article 122 stresses the principle of solidarity with member states through the EU in case of a severe or exceptional occurrence with a severe economic effect. And this is underpinning the construction of the guarantee system, and actually make this construction remarkable in double sense. First of all, is backed by guarantee, which may not be called by a few member states benefiting from as good as credit rating as the EU, for one, but also this requires the unanimity. So while the regulation is could be adopted in qualified majority, in order for the schemes to be available, you need unanimity. And what we reach here is this morning is a unanimous support around these schemes, which is not insignificant in terms of financial firepower, not least because it top up over mechanism, and this has to be seen is part of a more global package. So I will leave it at that, and I'm very happy to hear to discuss it. Thank you.
Thank you very much. Gilles, this was a very interesting presentation, and I see that there are already quite a number of questions that we will go back to after our discussion. So now the floor goes to Roel for his intervention, please.
Oh, yes. So thank you very much for having me here, and thank you, Gilles, for your very interesting presentation. My comments are purely in a personal capacity, so they do not commit the European Fiscal Board or any other organization. So let me start by telling you that I think this is a very useful instrument. It adds to a number of other instruments that are very important during this crisis. I should say that given the scale of the European economy, 100 billion is probably quite limited, but I think it's better than having no instrument at all. And I think the Commission should be commended for designing it so quickly. I think one should emphasize that this is not an unemployment scheme, it's an employment scheme. So it is meant to protect employment. And Gilles, in his excellent presentation, he explained how it works. So I just recapitulate very quickly. It is based on borrowing in the market using the collective guarantees of the signatories, and then the funds raised, they can be lent onto beneficiaries. Now, each participant, each signatory has a limit on its own liability, and then on a yearly basis, there is a maximum amount of 10 billion a year that has to be serviced. And then for the first 2.5 years, guarantees have to be provided, which is then up to a maximum of 25 billion. Now, the benefits I see, there is a net financial benefit to making use of the scheme, but I think it's quite limited. I see the benefits as broader, but there is a net financial benefit to the extent that a participating country, a country that makes use of it, could potentially save some interest payments. So borrowing can be at a very low interest rate, and this interest rate will be passed on to the country that makes use of the scheme. So there will be some net financial benefit, but it will not be very big because these are loans. But it could alleviate borrowing constraints in some cases where countries may have run out of public funds to respond to the crisis. Now, to be clear, if a country makes use of it, it has an effect on its public debt. And if it makes expenditures from the funds, then of course this will have an effect on the deficit. But I think the benefit is, it's not merely the financial benefit. I think the main benefit is that it increases the incentive to financially support, reducing working hours for employees to avoid layoffs and to support the self-employed. So I think it is the incentive that it provides for countries, at the national level to keep people employed. I think this is the main benefit, and then there are a number of benefits that are derived from this. Is that it helps to protect demand, it helps to reduce individual suffering from being unemployed, it reduces firing and hiring costs, which become important when the economy starts growing again, and it reduces a potential loss of human capital. So it reduces hysteresis effects. Now, an important question to me, and this is what the European Fiscal Board has been advocating for a number of years, is whether this could kind of provide a structure that, I know it's a temporary instrument, but that could be a stepping stone towards a central fiscal capacity that would be of a permanent character. So maybe Gilles could say something about this. Now, importantly, the SURE initiative, the SURE is a second line of defense. So it is meant to support national schemes. So that means that its effectiveness depends on the design of the national arrangements. And so if national arrangements are effective, then SURE is effective, and vice versa. So this is quite important. The scheme was, obviously, it was designed, under a lot of pressure. So there are no, and Gilles already explained that, there are no specific conditions. But, suppose the scheme would be prolonged at some point, then the question is, would it be possible to also impose some conditions? Because what you want to see is actually that in the end, it's individuals that benefit from it, and individuals who are not able to work. The time is idle. So how can they be incentivized to keep up, to for schooling, keeping up human capital, so being equipped to for the work once economies start growing again. So I'm wondering whether at some point there are possibilities for some kind of conditionality. So again, let me summarize. I think it's an important scheme. It sets an important structure, and I'm looking forward to seeing it alive. Thank you for your attention.
Thank you, Roel. And I'm sure, again, we will touch some of the points, at least, that you raised in the discussion with the Gilles in a few minutes. Now, Grégory.
Thanks very much. Good afternoon, everyone. Let me first, of course, Elena and the Florence School of Banking and Finance for co-organizing this event with us. It's really a pleasure to be back at the UI for me. And I also want to thank Gilles and Roel for their excellent presentation. So given that I have only 6 minutes, let me just tell you very quickly what are my, according to me, the main pros and cons of the SURE proposal. So basically, in terms of pros, I see 3 main advantages for SURE. The first advantage, of course, is that SURE provide an additional source of financing for European member states, in addition to the usual market financing and also to potentially to the ESM financing. And actually, one of the main advantages is that it could be cheaper for some country to finance themselves through SURE and to finance themselves on the market. It could be the case, for instance, for Greece, for Cyprus, for Italy, for Portugal, that have a higher borrowing cost than the EU, because the EU can borrow at 0% basically and can pass that rate to those member states. So that's the first advantage. The second advantage, in my view, is the governance of this scheme, which in my view is more suitable than the one of the ESM to provide financial assistance to member states in the current circumstances. What's good is the light conditionality of this scheme, because we know that conditionality was heavily criticized in some countries of the EU. And basically, the only thing that member states would have to do, as Gilles says, is to show that they use the money for short-term work scheme. So that's a good thing. The second thing that was not discussed, I think, by Gilles, but I think, but that I saw in the regulation is that basically the decisions would be taken at a qualified majority to release the money. And I think that's also very good because maybe it would lead to the fact that we could avoid to go back and consult each national parliament, which is a problem with ESM because it slowed down the process. And here, maybe we would not need that. Maybe Gilles can confirm that later, because I think it would be a good thing and it would accelerate the process. And the third, I think, advantage of SURE is that, as Roel already said, actually, is that it really provides an additional incentive for member states to put in place a short-term work scheme and to use it during this crisis. And I think, yeah, as Roel and Gilles say, this short-term scheme have been crucial to avoid a rise in unemployment and the breakup of the employment relationship between workers and companies, which can be very costly for both. So I think it's really good to have this kind of scheme in place. And actually, some countries have had a well-established scheme like this for a long time, like Germany, Italy, France, or Belgium. But others, including I think Cyprus, Greece, Baltic countries, etc., didn't have one before. Maybe they created some since the beginning of the crisis, but I think it's good if SURE provides them an incentive to create and to use those schemes. So those were basically the 3 main advantages. Now I'm going to play a bit more the devil's advocate, and I'm going to discuss the limit of the scheme. Because I think, and the same, I'm going to just stick to 3 limits. First, I think that even if SURE is cheaper than the market for some countries, I think the marginal effect on public finances will be quite marginal, as Roel already highlighted. I think given the size of SURE, the saving in interest costs will be quite negligible for member states. If you take the example, for instance, of Italy, I just take that as an example. If Italy borrows, like, let's say 20 billion from SURE at, let's say, 0.1% for 10 years, instead of borrowing, let's say, at 1.6% on the market, it would save basically 300 million per year. It looks like a lot of money, I said like this, but in the end, it's only represent less than 0.02% of its GDP. And we know that compared to the very high cost of the current crisis, it's very, very, very limited. And actually, something that we did not discuss is that, in addition, there could also be a potential stigma attached to the use of the scheme. It's not certain, of course, but it's possible, and we need to take that into account, that market could see the use of the scheme as a potential sign of weakness, in particular for the first countries that will use the scheme. And in the end, if they see that as a sign of weakness, they might ask higher rates on their own loans. So in the end, the savings that would be done, that will already be small, could also be lost because of the increase in the rate from the market. So that's something very important in my view. The second limit that I see is that maybe I think the Commission and the Council have been trying to solve maybe the wrong problem since the beginning of the crisis, because actually access to finance for member states is not a problem at the moment, thanks in particular to the ECB. And so basically, so they don't need an extra source of financing for the moment. They can just go tap the market. And actually, if access to finance was to become a problem, in the end, SURE would be too small to finance countries. And it would run into the same problem that the EFSM, which Gilles mentioned as the ancestor of SURE, ran into in 2010, which basically the Commission created the EFSM, but immediately they had to create the EFSF and then the ESM because the EFSM was too small. So SURE would be a bit larger, but not much larger. EFSM, I think, was 60 billion, and this is 100 billion. So this is the second issue. And the third is that I see, it's not an issue, but it's more also to dampen the hopes of those who see this as a first step toward a significant and permanent EU borrowing capacity, is that, yeah, Gilles said it clearly at the beginning, it's a temporary tool. And also, it's not an insurance mechanism. Even if the Commission mentioned, and I think Gilles also mentioned it in his introduction, that this is the emergency operationalization of a European reinsurance scheme. In my view, it's not really an insurance. It's really a lending mechanism, because in any insurance that you have, it implies ex post transfers, which here are not are absent or very limited to the lower interest costs, which are marginal, as we said. So basically, it doesn't solve the big problem of this crisis, which is the ones that Roel also mentioned, which is some countries will have their debt to GDP ratio increase by a lot, and this does not help reduce that. So that was my main point I wanted to raise. Thank you.
Thank you, Grégory. Thank you very much. And now the microphone goes back to Gilles. But before we do that, let me also add some points that I've taken also from the Q&A that have already came from the participants. So not in specific order of importance. The first one is on the allocation of the SURE. Of course, the fund is 100 billion. It can be big, it can be small, it will depend on demand, but there is the possibility that the amount is not enough, as also both Roel and Grégory highlighted. So the question is how is going to be allocated if demand exceeds the supply. So you said there are certain criteria, but is there any way a sort of first come, first served, or how do we think about the allocation of the fund? The second concern instead the funding of the fund. So you said, of the program, I should say, you said, so I think participants are sort of, I wouldn't say confused, but they ask clarification on the following point. Guarantees must be provided for the instrument to be able to reach the 100,000, because then the Commission will be able to issue bonds. But on the other hand, the participation to the guarantee scheme is on a voluntary basis of the member states. So how do we make sure that the member states will indeed participate And what happens to those member states that decide not to participate in the funding? I guess they will be recipient of the instrument if they ask for it, but maybe we want to clarify this potential mismatch between funding and allocation, which is something that in the European framework is a big novelty. So maybe we want to go a little bit deeper on this aspect. A related question to this is whether the bonds that the Commission will issue to finance SURE will be ECB eligible or not for their asset acquisition. And maybe one last question before you get the microphone back, the length. So Roel and Grégory also highlighted this is going to be a 2-year scheme to start with. So relative again to market financing, that's very short because normally countries issue bonds with much longer maturity, or at least a big part of it. So first of all, why is that so short? We understand the need and maybe the request of the member state that it has to be temporary, but why so short and why a 6-month extension period possible? So the floor is yours.
Thank you very much. Do you hear me? Yes, okay, perfect. No, thank you. I will take up the question. Many thanks for all, many thanks to Roel and Grégory. Many thanks for Elena, a very relevant question. I will start by the question raised by Elena, because I mean, it's an important clarification. So the allocation of SURE will be done not on the first come, first serve basis. It will be done considering all the requests and for actual or plan measure. So we will ask member states to reveal their preference so that we could have a comprehensive view of how many member states are requesting the SURE. And the allocation is will depend, I mean, on the how many. So it will be state contingent, how many member state requests. So what the regulation said, it will apply the principle of solidarity, equal treatment, transparency, and proportionality. So, and then we will apply this EU principle to the allocation. There could be cases where we are below the ceiling or above the ceiling. So this remain to be seen. On the guarantee, let be very clear. It's a voluntary basis because there is no obligation for member states for doing so. As Article 1221 of the Treaty of the Functioning of the Union have said, is actually that member states does that in the spirit of solidarity. But what they are asked voluntarily to do without legal obligation is to provide unconditional, irrevocable, and callable guarantee. So once they give the guarantee, so it's why, and I want to reassure you, when we reach an agreement with all member states. The agreement was a package comprising a regulation, which will be adopted in qualified majority, as Grégory rightly said, and it will be the case for the implementing act. But the guarantee will be signed by all member states. So all member states agreed to sign the guarantee agreement. So it might take time because they need to go through their national parliament or through the national approval process. But the agreement is a unanimous agreement. So it's an agreement to get not only the regulation in force, but also the scheme financially available. So it will be signed for all, and this was basically the outcome of this morning, which in a way is quite a revolution. I will come back to that. The last question by Elena, it's a very relevant one. This will be the sunset clause will apply to a period. So it was a request from some member states to deal, and I mean, it was a legitimate concern that member state wanted to hammer the temporary nature of the instrument, which was secured by the legal basis, which can only allow for a temporary instrument. But some wanted to have further guarantee, as expressed at the Eurogroup in the Eurogroup statement of 23rd April. But so this sunset will apply for the request for a loan, and it won't apply for the maturity. I think the guarantee system will be applied for basically a bit more than 30 years. So it will allow to issue bonds with a very different maturity, and this will be very important. First of all, to optimize their let's say financial condition, but it will be very important to make sure that the total exposure of the EU doesn't exceed 10% every year. So you will need a certain maturity profile. Now, let me go to the excellent comment, and very well balanced, I think, by Roel and Grégory. I think I see a lot of overlap, which is good, and it's very good to be the devil advocate. I mean, since the devil is in the detail. But here, so Roel is right to say that I think financially, it may, the benefit will be limited, but this depend on the financial condition. And if I may, it could have a positive effect on the market if the market believed that member states could continue to support their short-time work schemes, things they couldn't have had done in the absence of this instrument. So here, it won't only be the spread you keep, you benefit from basically the rebate on the spread, but it will be the guarantee that a member state could continue supporting this labor market scheme. And this labor market scheme will be very important to avoid that the recovery turn from V shape to U shape. So because if you start sacking people massively, I think unemployment has been on the rise in a few countries, but probably to a lower amount that we would have seen without these national schemes. Then you know, demand could be further depressed. You have a rise of precautionary saving, and you could aggravate. So the market could see as a second line of defense to keep these schemes. And I agree. So I agree with Roel that I think it's a final. I think the benefit is not purely the financial assistance. Is the target of the financial assistance, which is the short-term work schemes. On the conditionality, I think it is both, let's say, a feasibility problem and a political problem. I mean, the amount will be not negligible, but not overwhelmingly large. So I think member states, you know, won't renounce from their national prerogative for these schemes. So we thought that having a harsh conditionality would have been a very pose a political problem. It would have posed also a problem of definition. We wanted to avoid, we wanted to give the country the ownership, and in the spirit of the proportionality and subsidiarity principle, they know better. And it's what our president said when she announced the European Unemployment Reinsurance Scheme back in July, ends off basically the national design of the social security system, which is a national prerogative, and intruding into that is not only a political problem, it's an intellectual problem, because then you have to design standards, and this is very, very difficult. Moreover, there is, I mean, Roel said that the standard could be developed if you have a permanent. Okay, I could take the argument, but here also we needed to have an emergency. So the member states were taking measure in the situation of extraordinary uncertainty on the data, and we have to accept that. And we thought that conditionality was incompatible with the COVID-19 crisis. Roel mentioned the next step. What could be the next step? Certainly, this could be seen as paving the way to something more permanent. and the Commission has been clear. This proposal is without prejudice, so does not exclude basically a permanent scheme resting on a more permanent basis. So this could be considered, but what could be also considered is the political economy of that. And some member states, and it was clearly written in the Eurogroup statement of 23rd of April, said that their commitment to SURE didn't prejudge a support to a more permanent schemes. And there would be some reluctance. So in this could change, of course, but which could be expressed toward a more permanent schemes. I think now the priority is tackling with this crisis, one, and is trying to get the guarantee signed and get the instrument operational, so issue loans as soon as possible. So this is our priority. Concerning, I think, Grégory, I think we don't know how many member states, but I don't believe in the stigma effect in the sense that my hunch would be that several member states, so they won't be a first mover. I see the argument of the stigma effect. It always exists for this type of argument, but you can say that if member states if the market consider this as credible, it could reassure the market, saying that at least the country will be in the position to protect a type of expenditure of very high quality in order to act, which will perform, as Roel say in his Vox column, as actually a job insurance system. And I really like the term. It's a job insurance system. And the market has no interest in seeing actually the dire deterioration in the labor market. But regarding also the comment, so I could confirm the question raised by Grégory, that, and I mean, he was suggesting an answer, and the answer is correct. The implementing act will be done in QLD. And lastly, let me mention the very important issue related to the loan versus a grant. And I see that indeed a grant, so a payment, maybe is more appealing, but actually is not fully compatible, because SURE is part of a package. And you know, the Commission has also, I think it was on the 2nd of May, together with SURE, I mean, set up a corona response investment initiatives, the CRIP Plus, so kind of flexibilization of the structural fund, and short-term work scheme will be also, and over labor market schemes will be also eligible for this kind of structural fund support. But let me also, I think what Grégory said was very insightful, take a conceptual view of what a permanent scheme could mean. If you have a permanent schemes, and we have actually a paper with Nicolas Carnot and Magda Kisior on setting up a kind of quasi-insurance schemes, you will bump into a strong constraint. And it's a constraint also revealed by the EU citizens themselves in the survey experiment carried out by Frank van den Broek, a colleague of Roel of the University of Amsterdam. Actually, these schemes will work under the political requirement of absence of permanent transfer. And if you have absence of permanent transfer and purely insurance system, you could consider by in the period of time, the scheme will be, the insurance scheme will be balanced. So basically the transfer received, the payment received will be backed by future payment or a payment made upfront. So in a way, if you consider that you will have a system which is a purely insurance system with limited increase in debt, what you have is actually a loan, but a loan with not a fixed maturity as insure, but with a stochastic maturity, which depend basically how quickly your labor market has improved and you find yourself in a position to pay back the loan. But it's a bit of a loan-based system, because actually you don't receive a net payment of a longer period of time. You receive a particular insurance to weather the crisis. I need to stop here, but many thanks. It was I was slightly long, but I must admit that the questions received were very inspirational. Thank you very much.
And there are some more for you, Gilles, so you're not done yet.
Thank you.
So let me ask you a few more questions from the audience, and then maybe we ask Roel and Grégory if they want to add something before we close. So let me read actually one question which I find quite interesting. Would it be exaggerated to say that the SURE can serve as a blueprint for a future EU recovery fund? E-market expenses paid by a fund that finances itself by EU bonds without any conditionality in return for the e-marking of the expenses. I think this was very much a question I asked you actually informally when we talked the other day to prepare the seminar. And another one that I find quite also interesting is the Commission will issue bonds. What is the difference with possible Eurobonds? I know this is a word which should not be mentioned in Northern Europe, but de facto, what's the difference?
No, thank you. Do you want me to take the two questions?
Yes.
Okay. No, I think I won't speculate of what the recovery fund will be, but it's true that SURE it's a revolutionary system in the sense that because of the guarantee system, which is actually an embodiment of the principle of solidarity, because some member states won't benefit from it. Those who have good access market at the same condition as the EU. So in a way, it's true that it's a model we have, and it's true that it's also something that we could use for further crisis very quickly. It requires a council regulation, and it could be set up in the case of an health crisis, a nuclear rampage, a major flooding, a disaster. But I'm hoping that this event won't materialize. But of course, it's a model. SURE had set up a model. The second thing is the bonds, the Corona bonds, or the idea of having some mutualization. You have to know that it's a highly contentious issue. The issue of mutualization, it's very popular in some countries, but is much less from others. And actually, it's give rise to very difficult debate here. So actually, SURE was circumventing this problem by actually giving up on mutualization, and because I want to make a clear example. Imagine that you are one country, let's say a big country like Germany, and all countries around you default. All. Germany, with this system, will be eligible, will be liable to their 25 billion times EGNI contribution. So basically, we're doing 1/3 and 1/4. And so in a way, it's not joint guarantee. So it preserved actually a country from the risk of moral hazard, from the uncertainty of being the payer in the last resort. So in a way, it's a system of solidarity, but there is no, in a way, solidarity ex ante, but there is no type of the pure solidarity ex post you could have, but with a large level of uncertainty if you have mutualization. And honestly, if we wanted to do something, we better stay away from debate which are highly contentious. So it's a very different model, and we had to explain to the country that the guarantee were several and were not joint. But of course, you can see that the bonds could be a kind of corona-related bonds. So the effect also achieved by SURE is also relatively similar. The innovation of SURE, as Roel have said and Grégory, being more on the earmarking side, on the labor market side, that on the financial side. And the last point I want to say, I have been working on this file for 1 year, and back in February, just before February, I mean, I wouldn't have expected SURE to exist, and we were talking about a much smaller allocation of fund, not 100 billion. So this is a revolution, and you know why? Because also it's an initiative among the other showing that the EU care about the most vulnerable and care about the worker by ensuring their jobs. So it's also a powerful signal showing this reach out to the citizen, and also the commitment of the EU to develop the institutional setting to answer to a major crisis like this one in the spirit of solidarity and under the EU chapeau, because these guarantees are channeled through the EU. It's not an intergovernmental agreement, it's the EU method.
Thank you very much. I think the time is running up very quickly, so I apologize if I have not been able to ask you all the questions that have been raised by the participants, but we will send them to you. Maybe before we close, one word to Roel and Grégory. Roel, please, just 1 minute.
Thank you. And just very briefly, I think, I mean, it takes some time for SURE to come in place, but maybe this is actually somewhat beneficial, because now countries have the emergency measures, but they are running out. So actually SURE helps to prolong those measures. So actually the timing could be quite right. Then there was the issue raised by Grégory on stigma. Now, I'm not sure that there is really a stigma issue, because the market will see that there is a financial benefit, although it's not very big. So there is a rationalization, so to say, to make use of SURE. And on top of that, if I understand correctly what Gilles was saying, first the requests are collected. So there would be multiple requests, most likely there would be multiple requests at the same time. So I think the stigma issue will be kind of less, in that respect. So let me stop here, and thanks for the very clear explanations.
That's good. That's a good point that Roel made, and actually collecting the preference of countries could be useful if they all apply at the same time. I know not all of them will apply, but maybe multiple of them. Basically, to conclude, I just wanted to say that despite my criticism in my comment, I really think that SURE is a useful initiative. Also because, as you just said, Gilles, it shows that the EU can do some borrowing in the EU method, and not only in the intergovernmental way as it did with the ESM. So I think that's very important. And also I think, it will need to be a part of a broader package that include, of course, the recovery plans that will be presented before the end of the month. And I think this part will also be crucial. And so the package will need to be balanced between the two, and that will be important to provide the overall adequate response to the crisis.
Thank you. I think it's 3 p.m., so we should close the seminar, but I also want to thank Gilles and Roel and Grégory for participating with us, and Bruegel for co-organizing this event. And let's hope that indeed SURE, beyond what it is for itself, is going to be a method for the future. So this earmarking way of increasing EU budget and allowing the Commission to issue bonds, that is probably seen as a very positive step also going forward. So thank you again, and see you next time. Thanks again. Bye-bye to everybody.